Hello everybody and welcome to Project Trade. This is the Technical Indicators Show and it's the smooth moving average relegated to having a second M in its initialism to demonstrate its subordinates in creation to the simple moving average. It's in the name though. What it's trying to do, it's trying to smooth out that market noise and show a more accurate price assessment than the other moving averages. That smoothing process will mean that it naturally responds slower to changes in price than some of its competition, such as the exponential moving average or linear weighted average. It's a trade-off where those averages will give you more incorrect signals, but they'll also respond quicker to the genuine price moves. As a moving average, the smooth average is still attempting to find those trends. Nothing has changed there, and you do get a touch of momentum with these as well based on how steep the moving average line actually is. A very steep line would indicate stronger momentum, whereas a flatter line generally indicates weaker momentum. Whether you want a fast responding lower amount of periods as your input, or whether you want the longer term view with a higher number of periods, that will depend on your strategy and trading preferences. It's the same trade-off we just mentioned. Here, the lower the amount of periods you input, the more choppy and false signals you're going to receive, but they should also get you onto those true signals that much quicker. Let's check the formula for the smooth moving average. If we're starting from scratch with this one, then the first period is actually calculated as a simple moving average. That's just adding the source prices together for each period and then dividing that total by the number of periods. After that, we can jump into the smooth moving average formula for all the subsequent periods. First, you need to calculate the sum part, which is the smooth moving average value of the previous period multiplied by the number of periods that you've input. It's included in the key on the left hand side, and do remember, if this is just the second period that you're calculating, then the previous smooth moving average will be that simple moving average that we calculated before, and from then it would be the smooth average value. After we've worked out that sum, we can then subtract once the previous smooth moving average, and then in its place we can add on the closing price of the current period. Once we have that total figure, we can then divide it by the number of periods for our smooth moving average value. And here's what a typical smooth moving average will come out looking like. We've input our example with 75 periods, and as you can tell, it does look like a moving average because it is a moving average. In the top right hand corner, we've got our parameters for the indicator, and you'll notice that we do get the option to change either the price application or the shift input if that's what we want to do. Here's a selection of choices you may get on your platform for which part of the price data you would like the indicator to apply itself to. As I often say, I tend to avoid the high and the low options due to the way they spike more than the others, but you may have a strategy that caters towards those high or low numbers perfectly. It's up to you to do your dilly. And there's the shift input, which will just push the moving average X amount of periods into the future. So our Burleywood colored average is 40 periods ahead of the Dodger blue average. Averages with different shift inputs can then be used, for example, in moving average crossover strategies. So is the smoothing process worthwhile compared to the faster moving averages like the exponential? Again, this is sort of going to depend on what strategy you're after, but the key thing we've mentioned is that the smoothing average will give you less signals than its faster counterparts. If we take a look back at this 50 period comparison between the exponential moving average in aqua and then the smooth moving average in medium purple, at the beginning of the trend on the far left we can see how the exponential average takes off quick in pursuit of the price, and as the trend hastens, the more the lines separate as the smooth average cannot keep up with the exponential average. But once the trend finishes and price falls into a range up here at the top, the exponential average really struggles. Price is constantly flipping from above the average to below the average. It doesn't know what to do. It starts to go down for a candle or two and then reverses. It can make it tricky to read if you're trying to use that average for an interpretation of the overall market trend. This is the advantage of the smooth moving average with its casual composure. It's still catching up to price whilst the exponential is waiting there giving you false signals back and forth. Then only when the actual price reversal comes over on the right there does the smooth moving average finally turn and start a journey downward. Don't get me wrong though, we can certainly see that it's not perfect. Price does still jump a bit above and below the smooth average. It's far from immune to the uncertainty, but it does try and keep a clearer picture of the price situation. So what does all of this mean? Well, if you like the action and you want more signals, faster signals, then something like the exponential average is going to be right up your street. If you're happy to wait for those signals for something a little bit more reliable, if you want a greater probability of accuracy, then the smooth moving average is probably going to be more for you. Okay, and what kind of entry signals can we take from the smooth average? Well, it's the same entry signals that we could take from any moving average. So here it in fact isn't going to differ from something like the exponential average. The easiest of those signals is just to take a quick look at whether your moving average is currently sloping up or down. When the moving average begins to slope up, that suggests buyers are taking control over sellers in the dance, and so you might want to join on that blossoming trend as a buyer. And the flippity flip for that is when the moving average turns downward, the sellers are in charge again, so you may be interested in entering a sell trade. Another signal we've got is checking whether the price is closing above or below the moving average. Again, not too difficult. We can see in our example here that when price closes above the average, that's where we'd enter a buy trade, and when it closes below the average, that's when we'd get into a sell trade, yielding good gains in this particular example that we've chosen. Or instead of closing the other side of the average, what if price closed just short of the moving average and started heading back the other way in a continuation of the overall trend? It's using the moving average as a dynamic support and resistance line. So here you could enter a trade in the direction of the bounce. Price rebounds off of the average where the arrows are, and so you'd enter into sell trades at each of those points. Since we have the power of hindsight and selective data, we were able to jam this one together with a 60 period average, but you can find this type of pattern by retrofitting the average to fit the price movement on any given price chart on any given time frame. If price doesn't seem to be bouncing off of the 27 period moving average on the 2-minute time frame, try the 28 period, see if that works. The options are limitless. It is your life's plans laid out in front of you. And don't forget to try and get some profit out of these entries at some point too. They are coming in pretty quick succession. The last face from the Mount Rushmore of moving average signals is the moving average crossover. The gist is that on your chart you have yourself a fast moving average and a slow moving average. Once the fast moving average crosses over the slow moving average, that's when you'd enter your trade. So when the aqua fast average here crosses under that slower hot pink line, you are entering a sell trade. And then when it comes back up and crosses above the slower average, that's when you get into your buy trade. Unsurprising though, it's not all about taking your entry signals directly from the moving average. A lot of traders who use the moving average actually use it as a filter for their other entry indicators that give them their final say on their trade entries. For example, you could take the entry signal at the top of our list, and instead of using it to put you directly into the trade, you could say that you'll only enter buy trades as a rule if the moving average is sloping upward, and similarly, you'll only enter sell trades if the slope is downward. Moving averages are one of the most commonly used filters going, and often very easy to interpret. But now you're probably asking, hey, once we get into every one of these moving average trades, how do we actually get out of all of them? You can't just enter a trade and leave it open forever, just feigning that you're actually trading on the ultimate supreme grand mega master big Elliott wave cycle, when in reality you never figured out how to actually close a trade. So let's move on to what money management exit signals the moving average can give us to try and help us control our risk and stay solvent. The first trick we'll look at is the old turn them inside out trick. We take a few of those entry signals that we just talked about, and instead of using them for our entry signals, we use them as our exit signals. So for example, if you're in a buy trade and the price closes beneath your moving average, or the moving average slopes downwards, then you could exit your trade from that indication that the overall market trend has moved against you. So now we know that, even better, why not use the same moving average signal as both an entry and an exit signal? Enter a buy trade when the average slopes up, then when it turns down, exit that buy and get straight into a sell trade instead. Why not, right? I mean, there is a certain character building grit that comes from being broke all the time, and that kind of trait cannot be bought with money. A flexible element of money management which can be incorporated into your trade with a moving average is using the average as a trailing stop loss. Every new period you keep your stop loss in line with the current moving average reading, but you never move it backwards from once it's moved into your favor. If all goes well, this could help squeeze some more profits out for you if the market does trend nicely, whereas if you're using a ratio-based system where you take profit at a fixed distance from your entry price, then you could leave a lot of money on the table if the trend just keeps on running. As always, keep your total capital risk minimized regardless of how far your stop loss is from the entry price. Once you're in the markets, moving averages work across all assets, and the smooth average is no exception. They're a useful tool to help visualize the overall market flow over time, and are commonly used for that purpose even when there's no intention at all to trade off their signals. Still though, moving averages aren't without their pitfalls on the charts, so you should also be aware of what market events are occurring which may cause the moving average to be more volatile and therefore less consistent. Watch out for that stock market open if you are trading on stocks or stock indices. When you're on Forex, pay closer attention to news coming out which relates to the currency pair you're on. Some examples include jobs reports, the producer's price index, the consumer price index. All of these things can have an impact on the price, which will inevitably have that knock-on effect onto the moving average. Even if you have done everything top-notch with excellent form, there's no guarantee the indicator will stick the landing though. The smooth average is a trend-wanting indicator. No matter how smooth it tries to be, it is still susceptible to the range. Here's a nice looking pre-selected trending chart. Now imagine getting in on that move at the bottom when say price closed above the average, then using a trailing stop loss to follow that average all the way to the top of the trend. Good set of profits and you're enjoying the day. But you trade for too long and suddenly you are ambushed by the range. How many signals would we get here if we were entering our trade when the price closed across the moving average? At least 10 we found and highlighted there with the yellow rings, and that is an inane amount of trades to be taking over such a small number of periods. You are going to take a bath on pretty much all of those. Show me your winning strategy with the moving average here. It's game over, man. And it's because all you did was pay attention to the trend appealing charts that we've stuck up and completely forgot about the range. If the smooth moving average does fail you though, there's plenty of similar moving averages out there in the world that are giving you the same type of signals with the same type of problems. There's the exponential moving average, the double exponential moving average, the triple exponential moving average, and we are looking at getting these up to a quadruple, or if we're lucky, even a quintuple exponential moving average. Those are just some of the moving averages amongst many, and there's always that Ichimoku Kinko Ohio indicator. It's a bit of a jack of all indicator which has 5 parts to it. 2 of those parts operate in a pretty similar fashion to how moving averages operate, and they're called the Tenkan-sen and the Kijun-sen lines. Even though they have different names and inputs on the Ichimoku indicator, their formulas have the same base to them. They look back at X number of periods, then they take the high and low of price in that look back, then they divide that figure by 2. So it just gives you a mean average of the high and the low of price from the amount of periods that you're looking back at. Here's a visual with an input of 24 periods, and hopefully its similarity to something like the smooth moving average is clear already. It just gives you another option if you are losing sleep because you love the concept of the moving average but feel as though it's missing that golden touch. It's also worth noting that the smooth average is used in Bill Williams' alligator indicator. The alligator uses 3 smooth averages to try and get a conclusive verdict on when a market is trending and when it's in a range. In conclusion, it's still a moving average. It's not like if you jump from a simple moving average to a smooth moving average that you'll suddenly find this novel approach to trading where you emerge from the darkness of margin calls into an enlightenment of profitability. If you are someone who already knows the general gist of moving averages, then trying the smooth average is more like tasting a new flavor of ice cream. Strawberry flavored ice cream might be a bit more amicable with your taste buds than lemon, but if you are someone who'd brick the windscreen of an ice cream van out of an intense hatred for the dairy industry, then a slightly different flavor isn't really going to change your outlook on that. Maybe I'm not getting the point across. Let me try another example. If you already know the general gist of moving averages, then trying the smooth average is more like tasting a new flavor of chocolate. Orange flavored chocolate might be a bit more amicable with your taste buds than lemon, but if you are someone who'd brick the Milky Bar kid out of an intense hatred for how that character looks and dresses, then a different pair of boots and glasses on him isn't really going to change your outlook. But in the true fashion of a moving average, the smooth average has got diversity in its signals and uses. Plenty of entry signals to examine and interpret, along with its use as a filter for more effective entry indicators, but you are also getting those exit signals from it for your risk management. The smooth nature of the average can certainly be helpful for those who don't want the choppy action of the fast responders. We saw how the smoothing process tries to hone a slower average to improve overall accuracy, and how it can keep you out of certain ranges which something like the exponential average might drag you into. The self-imposed reaction challenge nature of the smooth average may make it more preferable for swing traders than the scalpers who are looking for a lot of action from a bounty of signals. That is it, and as always there is more information and links in the video description if that's what you're here for. Do not forget, in case it was not clear, every single chart in this video has been specifically pre-selected for showing you how the indicator may or may not work. It always seems a little bit different after you watch a video and then jump onto the charts, but I have used this indicator in live forward testing strategies and will also link those videos in the description too. This is Project Trade and I am the $1 Million Man, Trade DBRC. Thank you for watching.